Today, something unusual happened on Wall Street. Not something loud, not something dramatic, but something subtle enough that most retail traders won't notice until the move is already happening. The market today showed a pattern that almost always appears before volatility picks up. This wasn't here the type of movement you see on the surface of the S&P 500 or in the headlines. It was deeper, quieter, and far more telling. If you stay with me until the end, I'll break down the one signal that most investors overlook, but professionals watch every single day. Early in the session, the indexes opened in a tight range. Nothing surprising at first glance. But beneath that calm, the order flow started shifting. Several large trades hit the market across both growth and value stocks, and more importantly, across different sectors at almost the same time. This is not random. This is coordinated institutional repositioning, the kind that happens only when big money is preparing for a short-term market reaction. Tech stocks, which have been leading momentum for months, didn't behave as expected today. Instead of a strong continuation or a clean pullback, tech experienced a pattern of scattered buying and selling. When large institutions disagree on direction, it typically means uncertainty is building ahead of key economic catalysts. Traders who watch only price movements will miss this. Traders who watch flows can almost feel the shift happening. Meanwhile, financial stocks saw an unusual amount of rebalancing. Banks normally move with interest rate expectations, but today the activity pointed to something else. Some institutions increased exposure, while others simultaneously reduced risk. When that happens, it suggests preparation for a move that could affect credit conditions, treasury yields, or liquidity flows. Once again, this type of mixed behavior doesn't appear randomly. Options markets confirmed the same story. There was a visible rise in contracts targeting very short expiration windows. Not long-term bets, but short-term positioning. That is often a sign that traders expect a spike in volatility soon. Large orders hit both calls and puts, which is the clearest sign that smart money is preparing for a significant reaction in either direction. The bond market added another piece to the puzzle. Yields made a small but meaningful shift that hints at uncertainty around the next economic update. Whenever yields show sensitivity before major data releases, it signals that traders are bracing for impact. Whether that impact turns into a rally or a pullback depends entirely on the next economic numbers, but the preparation alone is telling. Consumer discretionary stocks, which reveal the strength of spending in the economy, also experienced targeted selling today. This usually happens ahead of reports tied to inflation or job data. If institutions expect softer consumer trends, they reduce exposure before the numbers are released. If the data confirms their expectations, the market reacts sharply. If the data surprises, the reaction can flip instantly. Everywhere you looked today, the same story repeated. Institutional hesitations, hedges, and early repositioning. These moves rarely occur without a catalyst on the horizon. And that catalyst now is the combination of inflation expectations, upcoming economic reports, and fresh commentary from Federal Reserve officials. The market is not waiting for the announcement. It is preparing right now. Now, let's discuss the signal I mentioned earlier, the one that very few traders pay attention to. The short-term volatility index quietly ticked higher today. Not a dramatic spike, but a controlled rise. Historically, this type of movement often appears right before the market enters a phase of sharp swings. It doesn't predict direction, but it predicts movement. And movement is exactly what traders prepare for. What makes this important is that the rise in volatility came at the same time as institutional hedging. When both happen together, it's one of the strongest early signs that the market is ready to shift. Whether that shift becomes a breakout or a breakdown depends on the next few developments. But the preparation phase has already started for traders and long-term investors. This is the moment to stay informed. Not to panic, not to rush, but to understand what is happening beneath the surface. You don't need to react before the market moves. You just need to know why the move is coming. And that is exactly why staying updated is critical. If you found this breakdown helpful and want daily clarity without the noise, make sure you subscribe to the channel and turn on notifications, because the next few days will define how the market sets up for the rest of the month, and you don't want to be last to see it.